We've arrived at our last segment for this forecasting session. We call it Pulling It All Together. We're going to take all of everything that we've talked about, thinking forward or thinking into the future. We're going to consider historic information that's going to help us to define what the forecast could look like and how it can be structured. And we're going to start to use that information to look forward. We're also going to show you a couple of techniques that are good for just analyzing the historic data so you know what you have and how to use that data to move forward. Let's get started. All right, to organize our thinking, I've prepared this slide for you. It's called the forecasting approach. We start off with reviewing history. We want to identify significant revenue and expense trends. So we want to look back in time and we want to see how our numbers have actually been moving. That's part of forecasting. Numbers do not move in a straight line. They either move up, down, they may move up rapidly, they may move up slowly. I have to understand how quickly these changes are occurring. The only way I can see it is by laying those numbers out side by side. This may be a good opportunity for those of you who know a little bit about computers to use Excel and go ahead and put your numbers into an Excel spreadsheet so you can actually see how those numbers are moving by creating graphs from those Excel spreadsheet numbers. We want to evaluate the impact of past decisions and economic impacts. For those of you who survived COVID, you know exactly what I mean. If you take a look at your numbers and you look at 2018 and 2019, and then you compare it to 2020, 2021, 2022, you'll see the impact of economic change. It will be very clear. Now, for those of you who started after that, 2021, 2022, now into 2023, you'll start to see some real subtle changes between 21 and 22. Because in 21, people were still coming out of shock. They weren't quite sure if they had a job. They weren't quite sure their income levels. And they started to buy, but they were buying slowly. When we got to 2022, all of a sudden all this pent-up demand happened and people started buying a lot. Now people are complaining about inflation. So they're starting to slow down. They're starting to get back to their normal. Looking at the numbers now, you'll see it's almost like a roller coaster. Numbers started to rise and they're probably starting to decline a little bit. And you just have to be prepared for that. It doesn't mean that you're doing something wrong. It just means that the market is changing, meaning customer demand is changing. But you do this review so you can actually see it happening, and that will help you to understand how to forecast forward. Then you want to verify your current record. You want to check the accuracy of your financial reports, income statement, balance sheet, cash flow statement. You want to look at any of your formal records, like your contracts, your leases, anything that you committed to in writing that you know will have a cost impact. You want to make sure those numbers are showing up correctly in your financial records. Then we want to develop what we call a pro forma. A pro forma is another name for a forecast. It's developed by creating the assumptions that we talked about earlier. An assumption looks something like this. I expect my revenues to grow by 10% higher than they were this year. That's an assumption. I expect my labor costs to remain flat or the same as they did last year. That's an assumption. I expect my leases, or my lease payment rather, to remain the same. Why? Because it's a 2-year lease and last year was the first year of that lease, so my lease payment will be the same going forward this year. That's an assumption. So what you want to do is start to develop a list of assumptions. Quickest way of doing that is just grab a piece of paper and a pen and just start writing them down. Don't get fancy, write them down somewhere. Then you can translate those or move those into an Excel spreadsheet or put them into some other forecasting program that you may be accustomed in using. You want to start evaluating the impact of predicted industry trends. What's going to happen in the future in the eyes of the experts? What are the newspapers saying? What are the business magazines saying? I need to be aware of what is happening around me. And clearly, I'm focused on my day-to-day. There are others who are focused on my industry. I need to learn who those people are and start to read their periodicals or their magazines or start to listen to their blogs. I need to also think about my competitors and how they're going to respond to the same things that they see, because they're also looking at the world around them and they're trying to make judgment calls as well. So I do want to think about how they may respond to the actions that I may take. We review history, we verify a current record, we're now starting to develop our forecast. Basic financial assumptions. Assumptions help businesses set realistic goals, allocate your resources efficiently, and identify potential risks and opportunities. What do we mean by allocate resources efficiently? We know we have limited money. Everybody does. So the key here is I have to make sure that I can estimate what I think the business may need in terms of equipment, in terms of new computers, in terms of space. Maybe I need to move to a new space. And I then have to estimate how much I think those things will cost, and I have to think about where the monies will come from. They also, in this case, the assumptions, enable management to make informed decisions based on the best available data and industry insights. If I'm out here looking at some of this industry information and they say that we're about to move into a period of a recession, this may not be the best time for me to expand a business. Now, I must make sure that the resource I'm using is reliable or is credible. So I do want to make sure I'm reading from maybe the Wall Street Journal versus I'm reading from someone's personal blog. So I want to make sure I check my resources carefully. Assumptions aim to create a comprehensive picture of a company's future financial performance by incorporating a range of factors. Those factors are the industry information and also your historic record. Remember, assumptions are designed to be flexible and adaptable, allowing for adjustments as new information becomes available or market conditions change. The assumptions are good for today. 6 months down the road, when the business is up and operating and we're into the new year, things may change. And therefore, I need to go in and make appropriate changes to my forecast. That's okay. Again, it's not about being precise. It's about being flexible enough to understand that the scenario may have changed. And I'm changing it not because I'm feeling uncomfortable. I'm changing it because I'm basing it on facts or I'm basing it on some evidence that has now been brought to my attention. How do I analyze all this information? You're asking me, Adam, to go ahead and collect all this stuff. So what do I need to, how do I use it? How do I, look at this? Well, there's 3 techniques that people use. And we're not going to be able to go into them in depth, but I at least want to highlight them for you. And you can read about these on the internet. They're all over the internet. One is called horizontal analysis. Another one is called vertical analysis. And the other one is called ratio analysis. So don't freak out over the word analysis. It just means I'm going to take my information and change the format of this information or turn it into a new format so I can read it, so I can go ahead and make some assumptions about what I'm seeing. So let's talk about how that's done. So when I look at horizontal analysis, this is one of these areas where I have to do a calculation. I want to know how much my revenues have grown from 2021 to 2022. I want to actually come up with a percent increase. So that is a calculation. Not hard to do. You can do it on your phone using the calculator, or you can do it in Excel using Excel. Or you can just do it on an adding machine if you want to do it. So here's how it works. It's a simple formula. I take what they call period 2 minus period 1 divided by period 1. So period 2 in this case would be revenues from 2022 minus the revenues from 2021 divided by 2021. That's going to give me a decimal number. So let's say it turned out to be 0.05. I then multiply 0.05 by 100%, and it now tells me that my revenues grew by 5%. So my revenues are now were 5% higher in 2022 than they were in 2021. That is it. I'm just trying to do that calculation to figure out how much the number has increased. I can do the same thing to find out how much the number has decreased. It's just going to give me a negative number. I can do that for my cost. I can do that for any financial number I have where I'm trying to compare it to another period, where I'm trying to compare 2022 to 2021. I can put all those numbers into this calculation and see what we call the percent change. That's what we mean by horizontal analysis. I'm looking at the future period, comparing it to the past period, and trying to see the magnitude of the change. And I'm going to show you an example a little further on. Next, I can do what they call vertical analysis. Vertical analysis is a calculation as well. And it's a calculation that shows a relationship to a central number. To put it in terms of a business, I want to know, when I look at my expenses, how large are they as they compare to my revenue? So if I look at my labor expense and I'm asking myself, this number is $10,000. How much of this is equivalent to my revenue? I take $10,000, I divide it by my revenue number, and it tells me it represents so much of my revenues. So if I have $100,000 in revenue, I would take the 10,000, that would be on the top. I divide it by 100,000, it's going to give me 0.10. I multiply it by 100%. It tells me that my labor cost, in this case, represents 10% of my revenue. So that's important for me to know. I know that out of all this money I'm making, 10% of it automatically is going to go to my labor. Maybe another 2% goes to my lease expense. Maybe another 50% goes to my insurance costs. I'm trying to figure out where my money is being spent. And an easy way of doing that is to convert my cost into percentages. And so by doing a vertical analysis, it allows me to do that. I take that expense and I divide it by revenue. And I do that for each one of my expense categories. The last one is what we call ratio analysis. This is something that accountants have come up with. You'll find it in any accounting book. These are particular calculations that all bankers do. These are calculations that all investors do. So you should just be familiar with them. You should be familiar with the calculation. You should be familiar with the ratio. The reason why they use a ratio name is because they tend to be division problems. I take one number, I divide it by another. So when I look at profitability, I'm taking my net income and I'm dividing it by sales. When I take a look at how much debt I have, how much I have in liabilities, I can create what they call a debt ratio. This is something that banks look at. I take all of my liabilities and I divide it by equity. So the amount that I've put in terms of being an owner. Or sometimes banks will divide it by your total assets. They'll take your total liabilities, divide it by your total assets, and that gives them a sense of how much the bank actually owns of your assets. Because the higher the percentage, the more the bank owns of your business. Profitability ratio, very common. Debt ratio, very common. So let's take a look at an example so that you can see how to pull this all together. We have this fictitious clothing company called Indulgence. As you see across the top, started in 2015. In 2015, they had $35,000 in revenue. Revenues have been going up. As you see, they have their various expenses, advertising, public relations, website marketing. I would encourage you to do the same thing. You can put something like this into Excel. You can take your actual financial record, put it into Excel. Therefore, you can see the numbers side by side. Again, this is what we're called reviewing your history. Your next slide, ratio analysis, I went ahead and calculated a couple of numbers for you. We're looking at profitability. I could take the profitability number for 1 year. In this case, it was $60,000. I divided by the revenues for that year. In this case, it's 2022, $250,000. So 60,000 divided by 250,000 gives me 0.24. I multiply it by 100%, and it tells me that I was 24% profitable. My profit margin in this case was 24% for that year. That's a very high profit margin for a retailer. That's doing very, very well. When I look at how much debt the company has, I know from the records in the company, they had $13,000 in loans divided by, in this case, their total assets. Their total assets total about $180,000. So 13,000 divided by $180,000 came out to be 0.072. Multiplied by 100% meant that they had about 7.2% of debt in this case. 7.2% of their assets were literally owned by the bank. 97% was owned by the founders of the company. That's in pretty good shape. It means they have very little debt that they use in the business. So let's take a look at the horizontal analysis. So if we're doing a horizontal analysis, it means that we first do the vertical analysis. We convert all of our numbers to percentages. As you see in 2015, we've done that. We've taken all of our expenses, we've divided them by the revenues. So with revenues, we divided revenues by the revenues. We take 35,000 divided by 35,000, that gives us 100%. And then for the rest of the expenses, we took each expense number and divided it by the 35,000 and went all the way down. It turned out that our cost of goods sold represented about 34% of our sales, 34% of our sales. And we did it again for 2016. We would do that for each one of the columns, 2017, 2018, 2019, all the way to 2020, because we want to see how those percentages may be changing over time. When we look down at the bottom, we see that we did the same thing for profitability. We took the profit for that year and we divided by the sales, and we see that our profit margin was 52%, still very high. After we've converted everything to percentages, we then can do what we call the horizontal analysis. As you see the arrow across the top, we want to convert it all to percentages so that now we can go from left to right and compare each and every year. And here we're applying both the vertical and the horizontal analysis. You'll see that we have percentages showing for each one of the columns, and now we can look straight across and see how expenses have changed over time. If you notice in 2019, we start to see a change in one expense in particular. We start to see a change in advertising. We're spending a little bit more on advertising. We've gone up to 2%, 3% in 2020, and brought it back down in 2021 to 2%. Public relations, we started to do some public relations in 2020 and 2021. We see a 1% number there. When we take a look at our marketing costs, website marketing, we see that it's been all over the place. 7% back in 2015, 5% in 2017, 4% back in 2020. So we see we've been spending at different levels when it comes to website marketing. Again, by doing a vertical analysis, we get to see the changes that we're making in the business from various decisions that we're making across the various expense line items. And we also get to see that horizontally. We get to see what trends are developing as we go from left to right. These two techniques are essential if you're going to prepare a solid forecast, because it allows us to see which items contribute the most to our business. In this case, which items contribute the most in terms of costs. If we go a little bit further and we take a look at revenues, what we know about this company is that at first they started off online, and then eventually they moved to add a retail component to the business. We can do the same thing again. We can look at percent increases from year to year in terms of our revenue for the online business as well as for the retail business. And we can see that in this case, the online business has been doing very well. The retail business, however, has suffered. This gives us new information, especially as we're preparing our forecast. It tells us that we can't just do a forecast that's looking at one number for revenue. We may want to do a forecast that splits the two. We do a forecast for online, we do a forecast for retail. If we should do that, then guess what? We can come up with a forecast in this case that shows the online business and the retail business. In this case, we just decided to do what we call a conservative forecast by saying, hey, the online business overall has been growing about 15% a year. We believe that in 2023, it's going to continue. So we're going to multiply our 2022 revenue by 1.15, which represents a 15% increase, and that brings us up to $218,500. We believe the retail business is still suffering. We have not been very successful there. We believe we can at least maintain sales year over year. So therefore, we're going to use a number of 60,000. Our estimate, our forecast for 2023 in terms of revenue is going to be $278,500. Because we did the vertical analysis and we know what the percentages are for each one of our expenses, we then can make independent estimates for our expenses. In this case, the owners decide to do 36% for cost of goods sold, do 4% for advertising, do 2% for public relations, 5% for website marketing, 5% for depreciation, 1% for electrical, 6% for insurance, and the rest. And then what we do is we take those percentages and we multiply them times the 278, or in this case, the 278,500, and that gives us individual numbers for our expenses. Gives us a total cost number, and we estimate that our profit will be somewhere around $57,105. We see also that our profit margin is going to be lower. Why is that? Because we're being conservative and we're making some choices about how we want to run the business differently to try to improve our retail business. In other words, we're going to spend a little bit more money, and we believe we're going to spend money in this way, and it's going to have this impact on profitability. That is a forecast. We take a look at history. We try to convert those numbers that we have in history by using a vertical analysis approach. Once we've done that, we then use horizontal analysis, looking from left to right to see how numbers are changing over time. Once we see that, we can then start to put some assumptions in place that will then drive or create our forecast. Again, I would encourage you to look at doing this in Excel. It'll make it a lot easier for you. It allows you to make adjustments quickly so that you can see the impact of various management decisions. Let's go ahead and recap everything that we've talked about in this session. What are the benefits that you can gain from forecasting your financials? 1, improve decision making. Why? Because now your decisions are more intentional. If you're doing vertical and horizontal analysis, it means that you're actually capturing greater insights into what's happening with your business, either due to economic changes or decisions that you've made in the past. It helps you to align your strategy with your long-term goals. It helps you to monitor and control the financial performance of your business. It helps you to communicate to your stakeholders, in this case, your employees. If you're monitoring what's going on in the business, you can alert them to the fact that maybe they're spending money in a way that's inappropriate for the business. You're spending more than you want or more than you can budget. So therefore, they can take corrective action to help you save funds. Helps you to anticipate and manage risk, also take advantage of opportunities in the future. Lastly, let's recall our session objectives. 1, we contrast the common business types, or we showed you the differences in the various business models and how expense categories differ between them. Also, how activities differ between them. That's important for helping you to develop your strategies moving forward for the business type that you have. We also explain how to use the income statement as a basis for your forecast, looking at revenue growth, looking at expense trends. Last, we demonstrate how to develop assumptions to help support your business forecast. You can develop assumptions by doing internal surveys as well as buying outside reports to help you better understand the trends that are occurring in your place of business and in your industry. So, thank you for joining us for this session, and on behalf of the Chicago Minority Supplier Development Council, I hope that you will continue to visit our website and enjoy the sessions that we've prepared for you. Have a great day.